love the channel and find it useful in becoming a happy retiree. Subscribe today. William joins us from Gwinnett. William, good morning. Welcome to Money Matters. How can I help?
Hey, Wes. I just wanted to get your opinion about automated investment sites like Betterment and their non-retirement accounts. I'd like to know the type of investor that would be best suited for something like this, as well as some of the benefits and negatives of using their service.
Now, you mentioned, so what William's asking about here, there's been this real, let's call it, you can call it an evolution. I would call it a ever so slight evolution, William, in the investment world over the last several years into what is deemed robo-investing. And you hear about companies like Betterment, Wealthfront's another name. I continue to talk about over time a company by the name of Wella, W-E-L-A, that I'm involved with. It's technically a robo or digital advisory firm. And the question I think William has, which is relevant to all of us listening, is that is this new term that you'll continue to hear more and more about, is there something new and better about, quote, investing or robo advice or digital financial advisors? Now, William, there's also another nuance I noticed in your question. It's something about whether it's retirement account or non-retirement account. Did you mean to ask that piece of the question, or is this more broadly, hey, are these robos a good idea or not?
No, specifically for the non-retirement accounts.
And why do you ask that?
Simply because I was considering investing into something like this, but I didn't know whether it would be best to go with something that was automated and pre-programmed, to fit my needs, or to go with a human.
Okay. So here you probably are asking non-retirement because you've already got your retirement accounts over at work. So you probably have 401k taken care of at work, and you're saying, okay, now I have money beyond my 401k. And it's, let's say, again, after tax accounts, is a robo good for that? Now I understand what you're saying. The difference here is that the question is, do you use a robo for any account? So you can have an IRA, William, or a Roth IRA at a robo, just like you can have a regular after-tax account. So it really, I would say, it's relatively agnostic or irrelevant what kind of account it is. It really just matters what are they doing from an investment standpoint at that robo that makes them a good idea or a bad idea. I would say the good on robos in general is that they are somewhat systematic, and there is a process in place, unlike some human advisors, let's say, that is diligent about doing rebalancing, which is an important piece of investing over time. So most of these robo firms or digital advisory firms are set up to make sure that your accounts are getting rebalanced, whether it's quarterly or semi-annually or even annually. At least there is some eye on making sure your allocation is suited to you, number one. Number two, rebalancing really works over time because it's almost a systematic way to harvest your gains and effectively sell high and buy low, right? Because if you get overweighted in an area because it's continued to grow and you shave a little bit of that off in a rebalance, you're selling what has done the best. You're reinvesting money into an area that has not done well. And traditionally, that's actually a very good methodology from an investment perspective. So but what's interesting about these robos is they're not necessary. There's nothing dramatically new about them. So I like the systematic part of it, number one. Number two, the costs are slightly lower, right? And that's why I'd say that's a good thing. What's interesting, though, is that Vanguard, for many, many years, has had effectively the equivalent of what the robo-advisors are really doing. So Vanguard Target Date Fund or asset allocation fund with an extraordinarily low fee that's been around for decades, let's say, or more than a decade, there's not a real difference in what the robo-advisors are really doing. So the fundamentals of good investing are still intact. Good, low-cost investing, like what Vanguard would do, or Schwab has programs for this, Fidelity has programs for this. Our digital advisor firm that I'm involved with, Wella, we do the same thing. Really what it's done is it's brought the same kind of systematic let's say, relatively low-cost investing methodology that used to be available for people only with $1 million and more. It's brought that to anybody, whether you have 10 grand, 50 grand, 100 grand, what would be considered tiny investments for big investment firms that only want to talk to millionaires and above. Now with $50,000 at a robo firm, you can get all the same things that 10 years ago, technically only the really ultra high net worth could get. So there's been I think that the whole movement of digital advice, William, has brought a better, more systematic way to invest for a lower price to everyone. And I think that's probably the best evolution that we've seen within robo-investing. So to answer your question very simply is yes. To use one of these firms for your after-tax money, I think is a great idea. The question here is just getting going, participating in markets. And you could do it at Vanguard, you could do it at Betterment, you could do it at Wella. Really, I think a lot of these areas are good options. Where the question comes in, where the price starts to differ a little bit, is whether you get any sort of human advice or not. And here's where the digital advice movement falls short. And we've even seen this recently in recent announcements by the biggest leading digital advisory firms, Betterment to be exact. They just announced not long ago that they are now offering human advice along with their digital advice or their robo portfolios for a charge of about 0.5% a year, because they realize that if investing is free with a robot, then at Betterment, how is that any different than you just plunk in $50,000 into a systematically rebalanced account at Vanguard, right?
Yes.
I mean, what's the difference there? And so what's interesting to me is it's almost as though, is this a big evolution or not? And I'd say it's not a giant revolution. The more that I've looked at the industry, it's not. Think about a big progress or big evolution is like, let's go from a horse and a buggy to an actual engine. Like, that's real technological progress, right?
Yep.
The robo movement is there's some progress there. It's slightly better. But it's more like, hey, I've got one windshield and windshield wiper, and now we've invented a slightly better rubber to go on the windshield wiper. So it's a tiny bit better, sure, but there's nothing really dramatic that's happened in this world. What's happened is that there is more low cost advice, systematic advice to more people. That's a big deal. As far as what the robos are doing relative to other investments that have been available for many, many years, not a whole lot of progress. So again, it's a good idea. I don't think I'm not going to steer you wrong by going to one of these robos. The key here is good, low-cost, systematic advice, broad allocations, and you're going to get that in almost every robo-advisory firm you go to. You're going to get U.S. stocks, internationals. You're going to get some sort of fixed income depending on your risk tolerance. It's going to be rebalanced systematically over time, and it's going to be relatively tax efficient, which is also something that's really helpful for your after-tax money, to be more specific on your question. So the answer is yes. My advice on the whole industry is that I think robo-advice is here to stay, because it's effectively just incremental progress to good, sound, fundamental investing that we've been talking about here on Money Matters for many, many years. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.